And you are going to see a crack in the bond market, okay? It is going to happen.
The 30-year Treasury is topping 5% for the first time since 2007.
We haven't seen a breakout of yields to these levels in quite some time.
I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money.
Bond markets around the world are starting to break. And look, this hits you if you hold Bitcoin, hits you if you hold stocks. Just today, the U.S. stock market wiped out nearly $1 trillion in market capitalization today.
We all know that 4.5 on the 10-year and 5% on the 30-year were always those lines in the sand that were going to start to cause investors to take a breath and see where we were and figure out why it was happening.
So why is this happening? Bonds are in crisis mode. But what's the reason? And how does it hit Bitcoin, especially when we're getting such nice price action going into the Clarity Act, fingers crossed? Let's talk about it. Because we haven't seen numbers like this since the 2008 crash. The U.S., case in point. The U.S. 30-year Treasury yield soars to 5.12%, the highest level since the run-up of the global financial crisis. Dear God. The UK's 30-year government bond yield surges to 5.85%, its highest level since March of 1998. And for Japan, no joke, this has literally never happened in their history. Japan's 30-year yield soars to 4% for the first time in history. So what's the actual reason bonds are getting repriced worldwide? Why are yields suddenly going up? Two reasons. Number one, inflation, especially the inflation right after the Strait of Hormuz shut down. Things are just getting pricier. Crop prices are up because of fertilizer. Car prices are up because of oil. Why would you lock your money away for 30 years just to make 4%? Inflation is sitting way above 4%. Nobody is parking their savings for 3 decades unless they get 5%, probably more. That's a loud warning to central banks and new Fed chairs like Kevin Warsh. You got to rein this thing in. It's getting away from them. The bond market is shouting that at you. So how do you actually bring inflation down?
I think the only solution is raising rates.
Here's the messy part. Back in the late 70s and early 80s, the Fed could just push rates way higher, and they did it 2 times because the first round wasn't enough. That kind of move was actually doable back then.
We've got, a model from the 70s. In 74, we didn't raise rates sufficiently. That ended up in stagflation and a real crisis. 79, we'd learnt from the central bank. We raised rates, and it was all over and done much, much quicker.
But we're not living in the 70s anymore. Kevin Warsh and the Fed are completely boxed in. America is already buried under $39 trillion in debt, and that number keeps climbing. A massive chunk of it has to be rolled over this year. The deeper the U.S. gets into debt it can't really carry, that's what flips the whole game. Push rates up, and the interest bill on that debt just keeps growing. And that's your spiral right there. This puts the U.S. on a debt death spiral with no real way out. And reason 2, real fast. What's pushing yields higher? Here's the second piece. Again, a lot of this comes back to Hormuz being shut. Central banks and governments around the world are dropping U.S. debt. If you're short on cash, if you got to cover higher oil prices, or just give your own people some breathing room, and the U.S. is a big reason Hormuz got closed, then of course you're getting rid of those treasuries. More supply flooding in means the market reprices and yields go up. So what does this mean for Bitcoin in the markets? Because where treasuries are right now, we are now at the level seen when President Trump implemented a 90-day tariff pause back in April 2025 due to the collapse of the bond market. If you go back through the charts, these numbers are basically the danger zone. Yields got to come down or everything starts coming apart pretty quick. The market now sees a 60% plus chance that the Fed's next move is an interest rate hike with rate cuts entirely priced out. We expect to see a 7% plus mortgage rate next, all as auto loan delinquencies have reached 32-year highs. And obviously, those numbers only get worse if rates go up, which means the Fed really only has 2 big moves here. Option 1, they jack rates up to historic levels like we saw in the 70s and 80s. That crashes everything. You're looking at a recession, maybe something worse. Remember what Lawrence Lippard, the macro investor, called out 11 months ago. He said this thing plays out in 12 to 18 months, 2 years tops. About 12 to 18 was his range. And why does he believe that? Because the moment the bond market breaks, the Fed gets forced into printing.
What I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. I mean, we know the third Fed mandate is if something breaks, they will print money. We saw it in '08, we saw it in COVID. And so What I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. And at that point in time, the Fed will suddenly pivot and say, well, we're trying to fight inflation, but we can't let the system fall apart. And therefore, we need to reinstitute quantitative easing. We need to, use yield curve control to cap the interest rates on the bond market. And we stand ready to buy whatever bonds are being sold by the market. I think that's what we have in our future. Now, what's really tough also is just we don't know when that's going to happen. It could happen tomorrow. I mean, I can't see it happening taking more than 2 years, but I give it. It could happen. They could drag this out for a while. It could be 18 months or so before it happens. But I think what we do know because of the math is that it has to happen because without more money in the system, you don't have the capital to pay the interest on the growing bond balances. So it's really kind of a problem.
Once the Fed turns on the money printer to stop stuff from snapping, that's your signal to start loading up on risk assets, at least how I see it. And the Clarity Act just got through the Senate Banking Committee, so next stop is a full floor vote. That vote is right around the corner. Lindsay Fraser, who handles policy at the Blockchain Association, says we've actually got support from both parties on this one. Here's her take on if and when Clarity gets passed in the full Senate.
I do think it'll take some time to stitch those together and figure out exactly what that looks like. And we will also have some outstanding issues in both versions of the bill that will need to get hammered out before it gets to the floor. But I think realistically, I know there's the will to move on this fast. I think a bipartisan markup yesterday.
This thing is not in the bag yet because the ethics part is still messy. Like if Trump's family or any senator or anyone working in policy, even the president, can run crypto businesses, that whole thing is still being fought over. The Dems aren't moving. And come on, Trump isn't signing something that locks his own family out of crypto. That's where everything is jammed up.
Ethics is really the number one issue. Both Senator Gallego and Senator Alsobrooks said that their yes vote in committee does not indicate that they will be a yes on the floor. They need some sort of ethics language. So that will absolutely have to be solved in one way or another before the vote gets to the full Senate floor.
Enjoyed this? Hit like, subscribe, and leave me your thoughts in the comments. Genuinely thankful you hung out with me today, and I'll be back with you in the next one.